In the market, we often see companies with high growth potential trading at sky high valuations. But here's a solid twist. Some businesses with no growth and no unique business still trade at absurd multiples. And that's when things get spicy. Let's consider this. The stock of Bharat Global. Now, they're a global trade facilitator. It rocketed 105 times from 16 rupees in November 2023 to 1,702 rupees in November 2024. Now, that's the kind of a chart that makes eyeballs pop and you also start skipping a few heartbeats. And then you ask the real question. What's exactly happening here? A flurry of corporate rejects. Now, they showed 6 shiny new subsidiaries, glossy reports of big ticket orders from names like McCain India Agro and Reliance Industry Limited, and all of that wrapped in the perfect "we are winning" package. Now, while the company's revenue itself flatlined for a decade, it suddenly shot up to 283.54 crore rupees in just 6 months of FY24. And the insiders were busy too. 99.5% of those shares landed with 41 new allottees through preferential allotments at steep discounts. It's like a backstage pass no one else got. But then the music stopped. A crash of nearly 85% that wiped out 2 things at the same time: the portfolios and the smiles. And the reason? SEBI. SEBI investigated and said the quiet part out loudly. A coordinated scheme, false and fabricated announcements, and the price rigging. It ripped the mask cleanly off. Welcome to Bottom Line by Grow. Now, today's episode is about a simple investing truth. A Warren Buffett classic. Price is what you pay, value is what you get. Now, which is a really nice way of saying, don't confuse the fireworks with fire. Okay, now the common thread is simple. Price is not value, and especially when you're talking about dormant companies rebranding into hot sectors like EV, semiconductors, or food tech. And the prices, they sprint far ahead of the numbers, to be really honest. So let's unpack 3 companies that rode on these really strong and powerful narratives to bring out some head-turning valuations. Watch. This is where the story meets the spreadsheet. Okay, first up, RRP Semiconductor. Now, RRP Semiconductor storyline is straight out of a makeover montage sequence in a reel. Now, once they were a dormant small timer called GD Trading and Agencies Limited, and suddenly they're glowing with a chip-themed name. From FY18 to 23, RRP posted virtually no revenue, 0 in most years, and just 38 lakh rupees in FY23. It's a whisper, not a roar by any measure. Now, losses piled up as well. Now, as of FY23, share capital was 10 lakh rupees, reserves were minus 8.39 crore rupees, and the net worth was hovering around the minus 8.3 crore rupees level. Equity basically wiped. Then came the 2025 pivot, a rebrand to RRP Semiconductors Limited, signaling a bold move into semiconductor and digital chips. It's the sector with the maximum sizzle right now as we speak in October 2025. And despite all this big talk, right, the numbers showed 0 fixed assets in FY25, hinting that there was more trading and distribution of components than, capital-heavy chip fabrication. Think brokerage, not foundry. Market went full sci-fi, pricing RRP like a chip champion. Stock up about 7,474 rupees as of 3rd October 2025. It's up 12,537% in a year. Market cap is around 10,182 crore rupees. Friends, this is nosebleed territory, by the way. But the valuation math, that was wild. PE at 1,567x, price to sales around 384x, and price to books over 600, because with barely any assets, you had all of the sizzle but none of the paneer. But here's the issue. Profit without cash. Now, on paper, FY25 looked heroic. Revenue jumped from 38 lakh rupees to 31.59 crore rupees. Losses flipped to 8.46 crore, and profit with a 26.8% margin. That would make veterans jealous. But the cash, now that was narrating a different story altogether. Operating cash flow at minus 18.78 crore rupees, meaning profits didn't show up at the bank. This is like Mirage in the Thar Desert. Working capital swallowed the cash, especially the receivables. the IOUs ballooned and sucked oxygen out of the entire room. Now, debtor days at 279, I'll repeat that number, 279 suggests that most of the revenue was tied up in unpaid bills, raising eyebrows on, sir, what are you recognizing as sales? Now, added to the jitters, operations also turned erratic. Q1 FY26 saw zero sales and an unaudited net loss, hinting that the FY25 pop might have been a one-off burst. Now, RRP's capital moves were just as dramatic. Preferential allotment of 1.35 crore new shares in FY25, that took their share capital from 60 lakh rupees to 14.12 crore rupees in one leap. Promoter stakes simultaneously collapsed from 74.5% to 1.3%, while Mr. Rajendra Chodankar emerged with almost 74.5% post-issue, except that allotment is under dispute with SEBI, which is a governance minefield. And the fog around who's in charge as a promoter is a flashing red light. Investors generally hate mystery in the cockpit. Now, worse, control shifted via preferential allotment without open offer or declaring new promoters, and this is likely crashing with SEBI's takeover rules that trigger around a 25% limit. And also the dual role, Mr. Chodankar as a creditor and then majority shareholder via conversion. Now, this moves into some self-dealing vibes, especially with 6 crore rupees of his loss flipped into equity. Now, net result, complexity, opacity, and serious governance risk. Now, this is a combo that market eventually starts pricing in. Now, that rally seemed powered as much by narrative as by numbers. Now, Economic Times noted that the stock reacting to big dreams LinkedIn post from the CEO was timed suspiciously well with all the price pops that were happening. Now, the trading pattern was also uncanny. You saw near vertical rises, 5% upper circuits, you had wafer thin volumes, dozens of shares some days, suggesting tightly controlled supplier and operator-like actions here. Regulators did take note. Now, RRP is now under additional surveillance measure. That's a very loud handle with care sign coming to you from the exchanges. Now, given all this, RRP could be a house of cards where the story runs far ahead of substances and mirages start looking like oases until you get much, much closer. Next company, Blue Pearl AgriVentures Limited. Same script, but different stage. Now, Blue Pearl was born in '94. They chilled out for years in textiles and foam as Blue Pearl Techspin Limited. I mean, this is a company so quiet you can hear their balance sheet breathe, by the way. Their annual sales were under 3 lakh rupees from FY19 to 24 with negligible profits or losses and negative reserves. Tiny numbers, tiny footprint. And then in 2024, there was a hard pivot, a rebrand to AgriVentures, a jump into agri-commodity trading. Now, this is a low-margin, working capital-heavy game where scale matters more than the cool slogans you can come up with. Now, to fuel it, they raised big. Preferential issues and warrants ballooned equity share capital from 25.6 lakh rupees to 60.26 crore rupees by FY25. The stock responded like a rocket, up 1,240% in a year and pushed market cap to 6,107 crore rupees as of 3rd October this year. You know, essentially expectations on an overdrive, like just before your board exam results. Valuations also turned extreme. PE at 9,287 and price to sales at 149 times their FY25 sales. These are numbers that scream careful. These multiples soar also over their peers, Apple's to space rockets. And despite this valuation fever, the reported performance had contradictions. FY25 revenue jumped to 35.3 crore rupees, that's 133x, but net profit was just 64 lakh rupees, that's a skinny 1.28% margin. Cash flow? FY25 operating cash flow was minus 59.98 crore rupees. The profit didn't become cash. The equity raise did the heavy lifting. Now, the drain came from the trade receivables and inventory swelling up like a sponge, working capital chewing through all the funds around. Customers took 345 days to pay. That means almost a year's sales sat as debtors' liquidity nightmare. And ownership also flipped. Original promoters dropped from 19.67% in September 2023 to 0.08% in FY25. Almost a total exit after the rally. Now, FII stepped in with 23.24%, and with a heavily diluted base, anyone in at early low prices could be eyeing exits as liquidity starts showing up. Now, exchanges slapped the stock under the highest surveillance bands multiple times in 23 and 24, basically saying price and financial health do not match. Essentially, the story is way louder than the spreadsheet. So far, the theme has been profits. That profits that don't become cash and cash flows that bleed. Well, risk at the far edge. But there's one more trap. Real explosive growth that's priced like a fairy tale. And that brings us to EliteCon International Limited. Now, EliteCon was once tiny. We're talking a market cap of 11.13 lakh rupees in FY21, sales of 10 lakhs, net loss of 4 lakhs. They reinvented themselves to tobacco, manufacturing and exporting cigarettes and allied products. This pivot actually delivered FY25 revenue of 551.36 crore rupees with 69.65 crore rupees in net profit. This is a rare case where the makeover came with the muscle. Now, Q1 FY26 was even punchier. 525 crore rupees sales, up 65% quarter on quarter, and 72 crore rupees profit, up 67% quarter on quarter. It's the kind of momentum that turns heads. They backed it with real assets as well. The manufacturing facility at Nashik signaling significant capacity, and it's not just headlines. Key check, cash flow. Operating cash flow at 2.57 lakh rupees shows profits hadn't fully converted to cash yet, with trade receivables at 99 crore rupees. That's about 18% of their FY25 sales. It's manageable, but you should keep an eye on that. Leverage here is nearly nil. Debt to equity is at 0.02, plus 22.64 crore rupees raised via warrants to fund their expansion. A sensible capital stack for growth. But the market went hyper. Stock surged 17,385%. You heard that right. That is 17,385% from August end 2024 to 2025. Pricing dreams decades into the future. At the 422 rupees 65 paisa peak on 25th August 2025, PE was at 914x and PS at 117x. Now, these are jaw-dropping multiples for any sector, let alone a regulated sector. That implied a market cap near 67,560 crore rupees, nudging into Godfrey Phillips territory, despite Godfrey's FY25 profits being only about 15x higher. Regulators stepped in here too. The stock landed under the long-term additional surveillance measure, and that's a sign of attention on volatility. And then physics stepped in, gravity. After the peak, the stock slid about 57% to 175 rupees by 3rd October in 2025, and that was a sharp reset in expectations. And even now, it's trading rich, PE around 397x, which is still stratosphere for most investors' calculators, by the way. And just for context, ITC Limited, giant, they trade around 25x PE, and EliteCon's multiple assumes flawless execution for years in a tightly policed industry. Translation of all that is, good business doesn't automatically mean good stock. Now, paying 397x earnings is betting on perfection, and perfection is rare. Now, the key takeaway is this. Valuation is the biggest red flag. No company outruns impossible multiples forever, even with real growth in the engine. The real question we should be asking is, do promoters, operations, and financial health rhyme with the stock price? If not, it's safe to expect a bubble to, first hiss and then burst. Numbers should be the compass, not the hype. What do you think? Are you seeing or smelling any stock today that is riding the hype to unsustainable heights? Drop your thoughts in the comments below. We'd love to hear it and dissect the story versus the spreadsheet. Thanks for watching.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.